Good morning and welcome to another edition of Main Management's Weekly Market Note. I'm Alex Varner, the head of research here at Main Management, alongside
James Maxwell, VP of Research.
and we'll go into the macro data that was this past week. On the performance side, for the trailing week, pretty mixed. Broad indexes were mostly down, S&P down 0.3. Commodities led the way, mostly driven by copper. That was popped that we'll talk about on some tariff implications. Sectors were mixed, but you had energy leading the way, utilities second, and then communication services and financials down the most in the week. But for the year, most things in the green/blue, depending on your color scheme. Consumer discretion and healthcare are the two down sectors in the S&P. Recession dashboard through July, as we stand now, not much has changed. That might get an update this week. We get a lot of macro data this coming week that we'll discuss as well. But for now, kind of things are continuing along as they were. On the data side, we got the NFIB Optimism Index. That's the small business survey. It ticked down to 98.6 in June, just missing forecast for a 98.7. You can see there it's still below the kind of long-term median, and it spiked heading in the election, had a couple of sharp pullbacks, then rebounded, and is now kind of maybe moderating.
Yep.
We've seen some volatility in there. The one thing is that we kind of noticed under the covers the forecasts for the future, because they ask about present conditions, they ask about expectations. The expectations are getting a little bit more optimistic. And you can see on the right there, that's the uncertainty index. And that thing really spiked. And then that thing has also seen some volatility. But the last several months, it's kind of been coming down in a more concerted way, which we've seen in some of the forecasts where businesses are a little bit more confident going forward. And we talk about some of the results in the next slide that show the evidence of that uncertainty that existed for the last couple of months. So hopefully that headwind is abating and we'll get kind of a continued decline through the rest of the summer.
Yeah.
On the CapEx side, that's capital expenditures, that was really evident. The firms that made a capital expenditure in the last 6 months was only 50%. That's the lowest since August of 2020, where this is, again, looking backward in August of 2020, we're coming out of COVID, firms, everybody kind of froze up. And that's what happened here is these firms, they saw February, March, April, May. They saw, okay, there's tariffs, uncertainty. We're not going to do any spending because we don't know what's happening. And now you're seeing that kind of pop a little bit looking forward, where firms are maybe starting to make capital expenditures. That did tickle down a little bit, but again, it's up from where it was 2 months ago, 3 months ago.
Yeah, there continues to be this kind of, earlier this year, a couple of months ago, there was this very, very, big weakness in the soft data, a lot of the survey data. The hard data was taking some time to actually reflect that. And now you're kind of seeing that soft data, a lot of that start to recover, maybe not look as bad. It's still on the weak side, whereas the hard data is just kind of muddling along, like not moving down harshly, which is like an interesting trend across all of this kind of survey data. As you saw this massive spike downwards kind of post Liberation Day, and then June and now July, it's kind of coming back slowly as people, it's climbing that wall of worry is the old saying.
Yeah, on the right there on the sales side, similar thing where actual sales changes improved, but are still net negative, which means more firms are reporting lower versus higher sales. And then but it is the least negative in over 2 years, since January of 23. So that's, you got to start somewhere, and hopefully you'll get to see that back up to positive, where more firms are seeing higher than lower sales. But we really haven't seen that consistently since pre-COVID. And even it is worth noting, and if you see it 2013, 14, 15, 16 there, they were net negative on the actual sales. So despite, the economy pretty much humming along, these figures weren't great. So it's not like we have a super high bar to surpass, but it is good to see it trending higher. And then the sales expectations tick down a little bit. But again, it is good to see more firms expecting higher versus lower sales in the coming 3 to 6 months. On the inflation expectations side, the New York Fed releases this monthly. This is different from University of Michigan, but they kind of tie together just because it's asking consumers what they think inflation expectations, or what they think inflation will be in a year. They declined for the 1 year in June. The 1 year forecast is now at 3.02%. That's lowest in a few months. The 3 and 5 year figures were both unchanged at 3 and 2.6. We kind of place less emphasis on those 3 and 5 year figures because it's so far out and a lot can change. But again, at least they're not going up. They on the Michigan side, they really spiked. And here on the New York side, they never really spiked in the same
No.
way, which is kind of interesting.
Yeah, that showed that at least the consumers that they were surveying, or at least the way that they asked the question, because that's so important.
Yeah.
It showed that people weren't looking for these tariffs to cause long-term inflation effects. They kind of knew that it was, if anything, a kind of one-off price increase that would affect the 1 year, and then, hopefully nothing else after that.
Yeah.
So that's why they kind of have stayed consistent around 3 and then 2.6.
Yeah. And then we also looked at on the right, they come out with a bunch of different kind of areas here, but home price expectations, we looked at those. Those are a big part of people's assets. Often, most of the time, the largest asset they own is their home. And home price expectations moderated a bit, with the expectation slowing to 4.8 and 3-year to 4.6. The overall median was unchanged at 3.0, but uncertainty ticked down a little bit. And this kind of ties in with the housing data and the high prices we've seen, where it's good to see people kind of moderating their expectations a little bit, because it's, okay, if you want to sell your house, you do want to sell it for a high price. But this is people kind of saying maybe these are starting to top out a little bit. We've seen the bulk of the price increases. You saw that on the housing affordability, the Case-Shiller and the NAFB home price indices have started rolling over a little bit. Again, TBD if that is a more sustainable trend, but these kind of generally point towards maybe a bit of softening on the price side, which is welcome, because mortgages are still up at 7%.
Yeah, it's like people are finally saying, okay, fine, I'll sell for the price that people are asking for instead of holding on to this.
Yeah, exactly. The financial situation within the survey of consumer expectations is something that's pretty telling as well. They look at credit availability as well, but we kind of looked at the financial surveys here, financial situation here. And basically, the long and the short of it is, versus a year ago, people feel a little bit more safe, I guess, or kind of safe is probably the best way. Content, maybe, but the about the same to somewhat better responses increased, and those responding somewhat worse declined. And then for 1 year out, you saw similar behavior where kind of people saying it'll be about the same to maybe a little bit better rose, while those saying somewhat worse declined. And again, that's a good thing, where you think consumers are feeling kind of just steady as she goes for the time being. What you don't want to see is the somewhat worse to very worse really ticking up, and both of those kind of declined this month. So that's a good thing.
It's on the margins getting better.
Yeah, just kind of, steady, but you're trending up rather than down, which is nice to see. We got also wholesale inventories this month. They were down 0.3% month over month in May, dragged down by durable goods, which fell 0.8%. That was their biggest monthly decline since June of 2020. You're clearly seeing kind of still some washout in the tariffs here. As these inventories are things that were sitting on shelves. When inventories decline, that probably is indicative of them taking them off the shelves, people buying them, which is a good thing. But again, still seeing the effects of kind of those, March, April, May tariffs. And that could continue now that we've got, more tariffs on Mexico and
this past week, and a lot of kind of other tariff uncertainty still kind of lingering in the background.
Yeah. And then non-durable goods were up 0.5%, which was the biggest increase in a few months. Year over year, they all kind of decelerated, with durable goods down, basically flat, but 0.04%. That's the lowest since November of 23. Non-durable goods up 3.9, and total inventories up 1.4. Then looking through at the kind of categories here, and this is just kind of fun. I don't know. It's interesting to see how they kind of break these categories out, because these are different from the import and export categories that they have, and the retail sales and the CPI basket. So it's kind of more of an interesting thing to see. But on the non-durable goods side on the left, petroleum was up 2.5, drugstores were up 1.8, and alcohol was up 1.7. I guess people are tired of thinking about the tariffs, so they're just buying that off the shelves. That kind of drove the non-durable good inventories build. For durable goods, you saw a decline in computer equipment, miscellaneous items, furniture, and professional equipment. And again, that kind of computer equipment makes some sense here, as people were buying that stuff off the shelves, maybe ahead of more tariff increases, or who knows.
Especially since those are so internationally made, with many different components from all sorts of different countries that people will front run those beforehand.
Yeah, and again, the durable goods are things that you don't buy often. It's like a toaster is a durable good. You buy a toaster every 5 years or 10 years. And so seeing these decline isn't surprising, because people bought a lot of these heading into the tariffs. So it's again, still seeing some shakeout on those tariffs here. One thing of note, this week when the commodity space was copper. There's the term Dr. Copper, which is kind of reviewed as a proxy for the global economy. When prices are up, it's indicative of solid demand for that metal. And that thing is used, metal is used in electric vehicles, military hardware, semiconductors. It is widely used. And Trump announced a 50% tariff this week, and copper prices immediately, and these are futures here, first position, shot up to a new all-time high. Retreated a little bit, but it's up at I think that's 560, 565, which is an all-time high. You can see very clearly these things are hypersensitive to announcements, whether or not this comes and is pulled back. But that could do some damage to the economy as far as, because we only produce about half of the copper we use. And so we'd have to go out and import the other half, which we do currently, and a 50% increase on tariffs on the pricing on that. Would be tough for kind of businesses.
A lot of those input costs of using copper and any like it says here, like everyday materials, computers, everything, anything electronic. Obviously, those prices will be passed through.
Yeah, so that could be a tough thing if that does come to fruition. Again, we shall see the way the tariff narrative has gone so far. It's been here one day, gone the next. So we'll see. But again, markets are very, very sensitive to this sort of thing. And then similar to copper, and we've actually continued this today, but Bitcoin hit 115K, just kind of worth noting. I think I've read some piece where somebody mentioned that the kind of froth around, or the rhetoric and sentiment around Bitcoin felt almost more elevated when it hit $20,000 than when it's at 119, I think, or maybe even 120 today. But it was just kind of interesting noting the sentiment around 20K felt a lot higher, and now we're 6x that. So, I think people are maybe just kind of getting used to it a little bit.
It's like sneakily reached all-time highs, I think, versus in previous periods, those landmark kind of numbers, whether it's 100K, 20K, whatever, were met with such, public
hot anticipation.
News articles, the whole lot. Which is just kind of showing how mainstream this asset class is now, to where it can reach all-time highs. Previously, that was a huge point of discussion,
and now it's kind of
one of the other 50 headlines this week.
Yeah, exactly. And then on the other side, we've got the S&P 500 dividend yield, which is down to one spot 2.8. It got as low as one spot 2.1. The point here is this chart, it's kind of hard to see, but it goes back to the 1800s. It goes back to 1870. And you can see, other than 2000, when this was at one spot 09, we're basically at the lowest levels on the dividend yield for the S&P 500 ever. And part of that is, I think, buybacks have become a lot more kind of fashionable or popular. When companies have cash, they will go out and buy back their shares, which is intended to boost their stock price rather than paying it out to investors. So there is something to be said here for kind of a scarcity of dividend-paying stocks in the market now.
Yeah, it's kind of gone, not out of favor, but less favorable, especially for these companies that want to be flexible with their cash, where you're paying a dividend, it's expected that you continue to pay that forever, and only increase it. Versus a buyback, if you have one great year, have a bunch of cash on hand, you can do that and be flexible with it, and choose when to buy back your stock to help the share price, rather than just being every quarter we have to pay out this dividend.
Yeah, because the dividend, as James said, is kind of, once you start it, it's really looked poorly upon if you start issuing a dividend and then cancel it. Like that, to investors, whether or not the truth is that investors don't like that at all. So companies, rather than saying, oh, well, if we make a decision to pay out a dividend, we're doing this in perpetuity, essentially. And honestly, they expect us to increase it. So why would we commit to that when we can maintain our flexibility? We do a buyback this year. If we don't do a buyback next year, nobody really cares. We can do it again the following year, or we can use it to CapEx, to use into CapEx. So that kind of dividend, perpetuity piece really plays a role in this.
It also reflects kind of just a higher growth, or type of growth companies you're getting generally in the index. A lot of like the Mag 7, for example. These are absolute cash machines, but they see it as they'd rather reinvest that money that they're making, the cash that they're making, into their business, into acquisitions, whatever it might be, rather than paying that out. Obviously, some pay out a pretty big dividend, like maybe Apple, I think, is the largest of those Mag 7, but many of them elect not to do that dividend, or do a smaller dividend, choose to buy back shares, or choose to do that, M&A or whatever it might be, back into the business, because ultimately they believe that the growth that they'll generate will be higher than
Yeah,
if
that's
they were to pay it out.
better for shareholder value than
Yep.
paying out a dividend that
Yep.
is fixed and stayed.
Yep.
So, worth noting kind of the lowest levels in 150 years here
Yep.
versus Bitcoin and copper and markets, honestly, at all-time highs. That kind of sums it up for the week. It was a pretty light macro data week. Coming up this week, we have CPI, PPI, which is the producer price index, industrial production. We get retail sales. We get the University of Michigan preliminary results. We get some housing data at the end of the week. So this is a pretty full macro week relative to last week, which was pretty narrow.
Yeah.
So that's it. Thank you for joining us again, and we'll talk to you next week.
All right. See ya.